Today we are looking at Johnson & Johnson. We have a lot to cover, so let's jump straight into it. We're going to take a look at their historical prices, how it has performed. We're going to take a little look into their balance sheet and their income statement to see how they are doing on a high level. We're also going to look at their dividend safety, look at some really important dividend metrics, financial metrics to ensure that they can keep paying these dividends. And we're going to end the episode looking at the stock valuation model. What is their intrinsic value? And given our margin of safety, what would be our acceptable buy price? And then we're also going to touch up upon Kenvue very lightly. So far we can see Johnson & Johnson currently trading around $158. Year to date, the stock has declined down 11% as a lot of money has gone into tech stocks, Microsoft, Nvidia, Google, and so on, and money has left the healthcare stocks. So as you can see across the board, they are down. The yield currently is sitting around 3%, and we're going to take a look at how that compares to the 5-year average. And for those who have been holding Johnson & Johnson over the long term, over the last 10 years, the stock is up 86%. Okay, now what we want to do is we want to take a very quick look at their balance sheet and their income statement. So if we jump in straight into the income statement, what we can see with a company like Johnson & Johnson, over the last 5 years, their revenue has gone from around 81 billion to their latest report in January 23 to 95 billion. So across the past 5 years, there has been steady growth, which you would expect from a mature company like Johnson & Johnson. Now, when we also look at the bottom line and we come to their net income, we can also see through the period it's also been the same from around 15.3 billion to their latest report of around 18 billion. So you don't expect massive growth with a company like Johnson & Johnson. You expect slow, steady 3 to 7% growth year on year, which we'll touch upon in our metrics, and they have been delivering that. One thing I like to look in our balance sheet is the cash versus the total debt. So if we look at their cash balance over the last 5 years, it's gone from around 19.8 billion to 23.5 billion. So again, there has been some nice growth just in their cash and short-term investments, which I think is positive to see. And then when we scroll down and we look particularly, as I mentioned, at their total debt, we can see here, December 2018, it was around 30.5 billion. And in January 23, in their annual report, it did increase to around 41 billion. Now, typically, that isn't something that I like to see with increasing debt. However, in our metrics, what we are going to take a look at is if they can cover this interest and how that fares when we look at their net debt to earnings before interest, tax, depreciation, and amortization. One thing I want to touch up on the Kenvue IPO, which happened at the beginning of May, we can see here that Johnson & Johnson still own around 1.7 billion shares, and that represents 91% of the total outstanding shares. So this did trade for $22 at the IPO stage, and now around a month later, we can see here it's around $24.84. In between there, it says 52-week range, but really it's just their month range, given they only IPO'd recently. Now, in the information that Johnson & Johnson have sent out, there has been no updates. However, it was suggested through the media that those holding Johnson & Johnson at the point of the IPO would be receiving some Kenvue shares. As and when we receive this information, I will update you all, but so far we are none the wiser in terms of what this will be. And do let me know if you want in a further video to analyze Kenvue, as I'm more than happy to do that. So we've taken a look at Johnson & Johnson. Now what we're going to do is we're going to jump into our financial metrics and look at the dividend safety. So they have a score of 99, which is very safe, and a market cap of 443 billion. It's a mega cap. And Johnson & Johnson, I believe, are one of 2 companies to have a AA rating in terms of the company. So that's very positive. Now, if we take a look at the key metrics, I think a few things that I want to point out before we go into the detail is they have been paying dividends for 107 years without a reduction, which is very positive for a company that you're looking to become a shareholder in. And another positive is they increased the dividend in the last recession, 07-09. If you think we're entering a recession or we are in one, then this is positive news. And I think more importantly, they beat the S&P 500 return in the last recession. Although it was a negative return, it still beat the S&P 500. And now we're going to dive into these metrics shortly. Dividend growth, I'll just touch upon here. As I mentioned, uninterrupted dividends without a reduction for 107 years. And even more positive, they've increased the dividend for 60 consecutive years, making it a dividend king. Dividend king companies that have increased their dividend over the last 50 years consecutively. And some really positive increases here. So April this year, 5.3%, and at 20 years, 9%. Their dividends has increased year on year. As I always say, you want 4% plus, as that is what the US inflation rate was over the last 30 to 40 years. So you will be losing purchasing power if you are not earning at least a 4% increase in your dividend. So far, positive. Now, what I really like to see when buying companies are that they are undervalued. One way of looking at this is the dividend yield theory. It essentially states that when the yield is sitting above the 5-year average, it is undervalued, which is the case with Johnson & Johnson. Their 5-year average yield of 2.65%, and we can see here that it's currently receiving a 3% dividend. So for me, whilst it shows it's undervalued, we never look at any of these models in isolation, and that's what we're doing in today's video. We're looking at lots of different methods to draw our conclusion. Sector PE as well, they are 14.9 PE for Johnson & Johnson, with the sector PE coming in at 17.4, so lower than the sector PE. And it's towards the lower end of that 52-week price range, which for me is always positive to see when looking to buy undervalued stocks, but by no means does it mean that it is undervalued, or does it mean it's overvalued if it sits towards the upper end. Quickly, I can also mention that the forward PE is also below the 5-year average as well, which is another positive sign to see for undervaluation. Earnings payout ratio, free cash flow payout ratio, as always, I always like to look at the free cash flow payout ratio, as the earnings payout ratio can be manipulated through earnings and accounting. So whilst I have the graphic here for you to see, we will focus on the free cash flow payout ratio. I always like to see below 60%, as this means that there is room to grow that dividend, ideally double-digit dividend growth. But I would say, based on what I can see, for the large part, it has been below 60%, and in 2022, it's been 68%. For me, that's no indicator of a red flag. I think at the moment it's fine, and I would just potentially keep my eye on this going forwards. Very quickly here, the earnings payout ratio below 60% is also positive to see for those that look at this metric. Likewise, for the earnings per share, I always like to look at the free cash flow per share, so we can focus on that. It's gone from $4.92 in 2013, and it's increased to 2022 at $6.55. Now, as always, with a company like Johnson & Johnson, I don't expect massive growth. I don't expect this to have tripled or doubled. So for me, I would say this is positive to see. And again, likewise, a quick mention, earnings per share, I think the growth is also very positive. Sales growth, as I mentioned, 3 to 7% is what I'd like to see of a company like Johnson & Johnson. And whilst they have had a year of negative in 2015, their range is between 1 to 7% and 14% in COVID 2021. So I think that's not too bad. Again, with the total sales, 71.3 million in 2013, and 10 years later, 94.9 million. Again, typical of a company of Johnson & Johnson's nature and stage in their business cycle. Now we move on to the shares outstanding. Typically, companies also return excess cash to shareholders other than just dividends, but through share buybacks. As we can see, whilst we prefer to see a declining graph, which is what this is, it's not really sharp enough for me to really mention anything else on this. Return on invested capital, one of my 7 golden dividend metrics. I like to see at least 10%. And as we can see here in 2022, the latest figure of 21% is very positive to see. So I believe that management are performing well and have over the last 10 years. Operating margin, again, above 12%, which they have performed very well year on year. And free cash flow margin above 5%, again, very well managed for Johnson & Johnson. Again, not really much else to say. Net debt to earnings before interest, tax, depreciation, amortization. Again, I did mention that their debt was increasing over the last 5 years. So as we can see, we like to typically see for a company of this size around below 3. And this basically means in 2022, It would take Johnson & Johnson 0.53 years to pay off all their debt net of cash on hand. So positive in my opinion. And again, net debt to capital below 0.4, which they have done year on year, essentially says 19% in 2022 of the company's financing was from debt as opposed to equity. So all positive to see. And now let's move on to our stock valuation model. Now, before I continue, do smash the like button, do smash the subscribe button, do let me know your thoughts in the comments as we go along. Now, Graham's valuation model, before I just jump into this, there was the case that Johnson & Johnson had the litigation, which I believe, I'm not sure if it's confirmed, but they did settle for around 10 billion, although I could be wrong. So please do let me know in the comments. However, now that that is out of the way, I believe that Johnson & Johnson has a good chance to now move forwards. So one thing to note here, so the reason why I've got the earnings per share, I'll mention this once we've revealed the intrinsic value. The earnings per share in 2023 is $4.77, the growth rate of 15, and the current yield on AAA corporate bond at 4.69 gives Johnson & Johnson an intrinsic value of $98.45. Again, we can see that is quite low compared to the current trading price. Now, the reason why I brought this up here is, as we can see in 2023, the earnings per share dropped significantly from 2020 to 2022. So that is probably one reason why the intrinsic value is quite low. So for example, if I put in 2022 here at 6.73, just for information purposes, it would be $138.90. So we will keep this here for now, but just thought I would put this there so you could see. Now we move on to the multiples valuation, where we input companies in similar size and similar structure. We have Merck & Co, AbbVie, and United Health Group. We input the stock price, the earnings per share, and this gives us the multiples. We then take the average PE multiple and multiply by the earnings per share to give a stock price of $118.99. Now we move on to the dividend discount model, where we input the yearly dividends year on year for Johnson & Johnson, and we have the growth rates year on year, and the average for the last 5 years is 5.75%. Now in my calculation, which is essentially the value of the next year dividend over the cost of equity less growth rate, I've gone for a growth rate in line with the last 5 years. I feel like with a business like Johnson & Johnson, it's very linear, so I would expect it to be very similar year on year moving forwards. This gives a DDM price of $183.04. Now we come on to our final model, the DCF discounted cash flow model, where we input the free cash flows year on year, and we have the growth rate in percentage year on year, which comes to an average of the last 10 years at 3.6. I've then taken the growth rate based on analyst estimates at 8%, which gives us our future free cash flows and terminal value. We then essentially use our discount rate to get the present value, and we sum these together, add cash and cash equivalents, subtract our total debt, and arrive at our equity value. Once we've divided this by the shares outstanding, we get our DCF price of $159.89. So as always, do like the video, do subscribe to keep that content coming. We have Graham's valuation and the other three that we just discussed on the screen. Our intrinsic value is essentially the four models that we have just gone through. So personally, I don't feel like Graham's valuation for this case is going to be relevant, as I mentioned earlier in the video. So we're going to remove the Graham's valuation and we're going to update our formula. And therefore the intrinsic value is coming in at $153.90. Just to show you, this is slightly lower than the current share price. Now, typically I'd like to go for a margin of safety of around 10%. Some people prefer 20% and some people have either no margin or 5%. It's all very subjective to the investor. So for a 10% margin of safety, I'd be looking to buy around just under $140, which is below that 52-week range. Now, for those who have a higher margin of safety, you may be looking at around 20% at $123. Now, Wall Street price forecast, we're going to end the show with this, believe that over the next 12 months, the share price will be around $180.95. Do let me know your thoughts on the video on Johnson & Johnson. Smash the like button, smash the subscribe button. Hope you enjoyed the episode and catch you on the next one. Thank you and have a lovely day.